bounce around a little bit. You know, in preparing for this, I was thinking about the presentation from your shoes, and obviously it's a fairly diverse audience. I tried to think about what I would want from me as a speaker, and I came up with 3 things. But I think in your questions, you'll let me know whether or not these 3 things are the right things or not. But the first is, why is private equity interested in physician MSOs? It has been a trend that has gone on for a long time, better part of 10 years. It's been really in full force. The second is, what are the key issues that private equity sees with physician MSOs? And I think the sector's been mixed, despite the fact that there's been a significant amount of interest in it. Some of the deals have worked out, but some of them certainly have not. And the third, given the fact that we're running late, is you want me to go fast so you can get to lunch. So as a result of those things, I'm going to bounce around a little bit. You guys have the slides in your book, and some of these slides are frankly really good to read and not great to present. And feel free to reach out to me after this to the extent that anybody's looking for any further clarity or any further detail about how private equity may think about things. But let me start with the first. So why does private equity like physician MSOs? The principal reason is that it's easy. It may not seem easy to many folks in the room, but at least the math looks easy. Private equity firms, by and large, don't like to take risk. Despite the fact that we only make money when we take risk, we like to take as little risk as possible. And physicians are arguably the only vital part of any delivery system. It's one part that you can't simply do without. Right, so as a result of being able to invest in the most vital part of the delivery system and do so in a way where you can control outcomes to some extent, it's very attractive. And I think this slide illustrates that in a simple way. So a private equity firm can buy a platform. And even if they pay a relatively large multiple, this is illustrated at 12 times, there's great ability to grow through acquisitions at potentially accretive multiples. So what the slide shows is a theoretical private equity firm paying 12 times and levering it 6 times for a platform, is what I call it, as $10 million of EBITDA, and then subsequently making 5 tack-on acquisitions, each with $1 million of EBITDA at 8 times. Even if you assume no synergies, even you assume no growth in the underlying platforms, because you're able to buy these tuck-ins at lower valuation multiples than the original platform, you make money. So here you are as a private equity firm, able to control your return by deploying incremental equity for growth, and doing so in a vitally important part of the delivery system that to most private equity firms looks like a pretty easy way to make money. But as folks know, it's what you put on paper is not necessarily reality, which drives me to my next point, which is what are the key issues that private equity firms have with physician MSOs? And the first is the fact that there are dyssynergies. A lot of times when people invest in platforms, those platforms aren't run with the same level of sophistication that ultimately a large cap private equity firm is going to need to see for exit. I was speaking with a gentleman out in the hallway before, and I use this saying that I'm fond of saying, that the value creation end of private equity is in the lower middle market and the middle market, because there's a lot of work that's required at that end, particularly in healthcare. A lot of times investors, they acquire regional platforms or local platforms that just require a lot of work to make them sophisticated. You need to put in place real compliance procedures. You need to put in a real finance organization, and all that costs money. And all that really is dyssynergies. Because ultimately, if I harken back to the last slide I showed, if you acquire that first platform for $10 million of EBITDA, after you're done putting in place the infrastructure that you ultimately need to sell the business, it probably doesn't have $10 million of EBITDA. It probably has more like 8 or maybe 5. So you do have dyssynergies that comes with really creating a platform that the public markets will accept as an IPO candidate, or another larger cap private equity firm may accept as an acquisition candidate. So that's one significant consideration. And the next significant consideration is the need for income repair. A lot of the physician MSOs, the way that the physicians look at it is they lose money on a go-forward basis. They lose income on a go-forward basis. And the right-hand slide of this slide illustrates that point. So if you have a group that today is just a simple partnership, the partnership earnings is what's distributed to the partner docs. After the docs sell or capitalize a portion of their earnings to the private equity firm, their longer-term earnings decrease, all else being equal. Yes, they received a multiple of the earnings that they're capitalizing, but the day after they've cashed that check, they forget about it, and they realize that the future checks that they get are half of what they were before the transaction. So a real private equity firm and the physician groups really need to understand how income repair is going to come. Does it come from physician extenders? Does it come from rate escalations, which obviously is a politically charged topic right now. But there really needs to be a strong fundamental reason why the deal should work, or how income is going to be repaired so the deal can work. So what I did was I took a look back over time and saw the most mature sectors of physician MSOs in the two segments where they principally exist. So, and I'm oversimplifying everything here, so please bear with me. To the extent you want to go a level deeper, I'm very happy to do so. But I consider physician MSOs to be really in two segments. There's the hospital-based and then the office-based or ambulatory settings. And hospital-based is more mature. This is a segment that has been subject to private equity investment really for a long time, since the 80s, really. And in particular, emergency department physician groups have been consolidated really since the mid-70s. This is very mature. And the office-based is less mature, but in certain segments, particularly dental practice management, it's a sector where there's been a significant amount of success of private equity firms in investing in physician MSOs. So what I did was I took a look at these two broad segments and tried to determine what are the key characteristics of those areas where consolidation has been most successful, because there must be lessons learned that can be applied to other segments. And I'm sure the folks in the room have seen that there's been waves of consolidation in different segments. Like in the hospital-based, first it was ED, and then it was anesthesia, and then it's hospitalist, and now it feels like it's radiology. And in office-based, there has been waves also, and a lot of that occurs just for cultural reasons. You know, the physicians see their friends doing deals with private equity firms, and they think it's an attractive place to make money for themselves. So they do, but some of it does have to do with real fundamental reasons. And that's like, one of the key takeaways I hope folks take from this is that there needs to be a real fundamental reason why consolidation makes sense in that segment in order for it to work. Because of the bad reasons, which I walked through, the dyssynergies and the need for income repair, a deal just to do a deal, to capitalize earnings or to create a larger business is not going to work. It's not going to work unless there's a fundamental reason for it to work. Like, I think people are fond of the saying, you know, in healthcare, you can, you know, make money by doing well or do good by doing well, or however people say it. But, you know, we should really consider that when we think about investing in this segment as a private equity industry. And I think a lot of times we don't, because the attractiveness of making money in an easy way is there. But the fundamentals need to support consolidation in order for the long-term value to be created. And that's what I tried to tease out of looking at these two individual segments. And you see here on the next page, in the hospital-based segment, which is by far the most mature, there are some points of commonality. I think the biggest point of commonality is presented on the bottom left, is the fact that the docs that have been consolidated in successful ways are not the money makers. They're not the brain surgeons. They're not the orthopedic surgeons. They are largely the support cast. And as a result of that, they behave a lot more like team members, and they are easier to help work together with to create a business. The second aspect of it is that there's an ability to create businesses around these physicians through clinical extenders, through shared back office, through common contracting to create some value. And I think these things need to be applied to other segments. And when there are points of similarity, I think you're likely to see greater long-term success in those consolidation plays. On the office-based side, it's somewhat similar in that there are common themes that have come out of the two most mature segments, which is dental and veterinary. I think arguably urgent care could fit in here too as one of the more mature areas, although that industry still, I think, is in its infancy of consolidation. And the key trends here are consumerism. So businesses that really, where the brand or the sites drive more value than the name of the physician is a point of commonality between these most successful areas. I think the need for scale, a trend of less sole proprietorship in the segment caused by changing demographics of clinicians that prefer to be more employees as opposed to sole proprietors, also lends itself to greater degrees of success in this segment. So I think that, you know, it's these areas that, or these points of commonality, that if one extends these points of commonality into other end markets and sees where they apply, I think you're likely to have greater success of consolidation. So this last page, page 5, really is a summary of all those key learnings. And you see on the left-hand side, it's the characteristics from hospital-based and office-based. On the right-hand side, it's just some ideas of end markets which may see consolidation on a go-forward basis as a result of those attributes. And you see that on the hospital side, if you have the way to read this, is, you know, if you're looking at the characteristic of the physician group, and if they are more supporting cast as opposed to revenue producers, you're likely to see a greater opportunity for physician-based MSOs. If you, on the office-based side, if there's a higher degree of consumerism in the sector, you're likely to see a greater degree of success. And on the right-hand side, it's just some ideas. I do believe that, you know, radiology, intensivists, certain areas of behavioral health are areas that are more ripe for consolidation. On the office-based side, dermatology, allergists, reproductive endocrinologists, I think is a little bit more challenging, but certainly feasible. But so let me stop there. Obviously, I've got a couple other slides, but I think just given the time, it's probably best to leave those for read behind documentation, or I'm happy to use those slides as supporting, as a support for any questions that folks have. Okay. Well, thank you. Hope everybody has a great weekend.